Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. This is the fourth video of a 5-part series on technical indicators. In this video, we're going to look at one of my favorite indicators, the Moving Average Divergence Convergence, or the MACD indicator. This is a trend following momentum indicator and helps to identify a trend. Since most money is made during a trend, this is a powerful indicator to add to your trading toolbox. Right, let's talk about this. What is the MACD? The MACD is short for Moving Average Convergence Divergence. It is a trading indicator used in technical analysis of stock prices, created by Gerald Apple in the late 1970s. It is designed to reveal changes in the strength, direction, momentum, and duration of a trend in a stock's price. This is a trend following momentum indicator, which is normally displayed below a price chart. The indicator plots a MACD or value line on top of a signal or average line. A buy confirmation is generated if the MACD crosses above the signal line, and a sell confirmation is generated if it crosses below the signal line. How is the MACD calculated? First, a 12-period and a 26-period exponential moving average is calculated. The 26-period EMA is subtracted from the 12-period EMA, and this results in the MACD line. Since this uses exponential moving averages, it has a greater weighting towards more recent data points. The MACD line can be positive or negative and is plotted on an oscillating graph above or below a zero line. Next, a 9-period exponential moving average of the MACD line is calculated, and this is called the signal line. If you are unsure of what a moving average is, then I have a video about moving averages, which you can watch by clicking on the card above. The MACD line is put on top of the signal line. If the MACD line crosses above the signal line, then this signals a buy, and if it crosses below the signal line, this signals a sell. The difference between the MACD line and the signal line is also represented on the graph as a histogram. The histogram is used to show upward or downward momentum. How do we use the MACD? The first way, and probably the most important way of using the MACD, is to identify if the trend of a security is bullish or bearish. This can be seen in the following example. If the MACD line is above the zero line, then this would indicate a security is mainly bullish. If the MACD line is below the zero line, then this would indicate it is mainly bearish. Now, if the MACD line was to cross below the signal line, this would normally indicate a short. However, there are many times this does not lead to a sell-off and gives a false signal, as the underlying is still mainly bullish. Conversely, if the MACD line is below the zero line and it crosses above the signal line, this does not always mean it is a buy, and it is still mainly bearish. So, how do we know when to buy or sell? Remember, the trend is your friend. You should always trade with the trend. Therefore, if the MACD line is above the zero line, then this would suggest the security is bullish, and here we would only go long. We would wait for a pullback, and only once the MACD line crosses above the signal line again, we would go long. The trade can be held and exited once the histogram loses momentum, or when a sell signal is triggered. Similarly, if the MACD line is below the zero line, this would suggest a security is bearish, and here we would only go short. Again, wait for the MACD line to cross back below the signal line, and this might be an opportunity to go short. The trade could be held and exited when the momentum is lost or a buy signal is triggered. As a general rule of thumb, don't go short if the MACD line indicates a security is bullish, and don't go long if it's bearish. Like most rules, there are exceptions, and your discretion needs to be used. If there has been a large pullback and the MACD line is far below the zero line, then this might be a time to go long, as a reversion to the mean may be likely. This was seen during the recent sell-off at the beginning of the coronavirus pandemic. If there has been a large move up and the MACD line is far above the zero line, then it may be worth going short. Take note that using support and resistance levels may help to determine a reversal. What are the problems with the MACD? Like most indicators, the MACD uses past data and moving averages, so it's a lagging indicator. This means that buy or sell signals are given after a change in price direction, and it will sometimes generate false signals. False signals can be reduced by using the MACD with other indicators like a moving average. For example, we might only go long when the 50-day simple moving average is over the 200-day simple moving average and the price of the underlying is above a 20-day simple moving average. In summary, the MACD is a trend-following momentum indicator. If the MACD line indicates a security is bullish, then only go long, and if it's bearish, then go short. Take trades in the same direction as the trend and use moving averages to confirm a trend. If there's been a large movement in a specific direction, then it may signal a reversal. Discretion, along with support and resistance levels, may help to trade a reversal. Always remember to paper trade any new indicator and to use a stop loss to limit losses. So, what's your favorite indicator if you had to choose one? Let me know in the comment section below. If you have enjoyed this video, then please don't forget to click the subscribe and the like buttons. This will help to support my channel and you'll be notified when the next video in the series is released. Thanks for watching and I'll see you in the next video.